Most Australians leave money sitting on the table at tax time. Not because they're doing anything wrong. Not because they made mistakes. Simply because nobody ever handed them a plain English checklist of what they're actually entitled to claim. This video is that checklist. We're covering 7 deductions that are fully ATO approved, apply to the 2025 to 26 financial year, the return you'll be lodging right now, and could, depending on your situation, put a meaningful amount of money back in your pocket. Stay with me until the end, because Deduction 6 is one that most Australians either set up too late or miss entirely. And it could make a significant difference to your tax bill this year. Before we get into the list, there are 3 things the ATO checks before accepting any deduction. You need to tick all 3 boxes. No exceptions. Rule 1. You paid for the expense yourself and nobody reimbursed you. Rule 2. The expense is directly connected to earning your income, not something that's just convenient or vaguely work-related. Rule 3. You have a record, a receipt, a bank statement, a diary entry, something that proves the expense actually existed. If an expense ticks all 3, you're in good shape. If it doesn't tick all 3, you're not entitled to claim it, even if it sounds like you should be. Keep those 3 rules in mind as we go through each deduction. Deduction 1. Working from home. If you've been doing any portion of your work from home this financial year, you may be entitled to claim a deduction for the additional costs that creates. For the 2025 to 26 income year, the ATO's fixed rate is 70 cents for every hour you worked from home. That single rate covers the extra electricity and gas you use, your internet and phone usage while working, and consumables like printer paper and stationery. All of it bundled into one straightforward figure per hour. To put that in practical terms, if you worked from home for around 800 hours across the year, which is roughly 3 days a week over a standard working year, your deduction under this method comes out at around $560. Now, 2 things you need to understand about the fixed rate method. First, because electricity, internet, phone, and stationery are already included in that 70 cents. You cannot claim any of those costs separately elsewhere in your return. That's called double dipping, and the ATO will pick it up. Second, you can still claim work-related equipment on top of the fixed rate. Things like a monitor, a keyboard, or a dedicated desk chair. If the item cost under $300 and you use it mainly for work, you can generally claim the full amount up front in the year you bought it. Over $300, it gets depreciated over its effective life. The alternative to the fixed rate is the actual cost method, where you calculate the real work-related proportion of each individual expense. It takes more record keeping, but for anyone with a dedicated home office, high energy bills, or significant equipment costs, it can produce a larger deduction than the fixed rate. If that sounds like your situation, it's worth running both calculations before you lodge. One thing applies to both methods. The ATO will not accept estimated hours. You need a genuine record of your actual hours worked from home. Timesheets, a roster, a spreadsheet, a calendar, anything you've been keeping in real time throughout the year. Deduction 2. Work-related vehicle use. Let's get the common misconception out of the way first. Your daily commute from home to your regular workplace is generally not deductible. The ATO treats that as private travel, and it doesn't matter how far you drive. What can be claimable is using your own car for work purposes during the working day, driving to visit a client, traveling between 2 different work locations, or making a trip to pick up supplies for work. For the 2025 to 26 financial year, the cents per kilometre method lets you claim 88 cents for every work-related kilometre you drive, up to a cap of 5,000 kilometres. At that cap, the maximum deduction is $4,400. That single rate covers everything: fuel, registration, insurance, servicing, and the decline in value of the vehicle. You don't need individual receipts under this method, but you do need to be able to show how you calculated your kilometres. A diary, notes on your phone, or a dedicated mileage app all work. If you're regularly driving well above 5,000 kilometers for work, the logbook method is worth considering. You keep a detailed record of every work trip over a 12-week period. Date, odometer readings, purpose of the trip, and that logbook can remain valid for up to 5 years, as long as your work travel pattern stays reasonably consistent. Your deduction under this method is the actual business use percentage of all your vehicle running costs, with no kilometre cap. One more thing worth knowing: parking fees and road tolls are generally not covered by the cents per kilometre rate. That means you may be able to claim them separately, even if you're using the simpler method. Deduction 3. Self-education. This one surprises a lot of people, but if you've studied, completed a course, or attended professional training this year that directly relates to your current job, the ATO may allow you to deduct those costs. The key test the ATO applies is this: the study must either help you maintain or improve the skills you already use in your current role, or be reasonably likely to increase your income in that same field. A nurse completing an advanced clinical qualification. A bookkeeper doing a tax agent course. A project manager working through a leadership program. Those are the kinds of things that generally meet the test. What won't meet the test is study that's about moving into a completely different career. Even if it's valuable and well-intentioned, the ATO's position is clear. Self-education deductions need to connect to how you currently earn your income, not to where you want to go next. Costs that can be claimed include course fees, required textbooks and study materials, stationery, and travel to attend classes or workshops where that's relevant. Keep every receipt, and if a course is partly personal and partly work-related, you'd only be claiming the work-related portion. Deduction 4. Income protection insurance. This one is claimed by far fewer Australians than should be claiming it. If you're paying premiums on an income protection policy that sits outside your superannuation, meaning the premium is coming directly out of your own pocket, those premiums are generally tax deductible. The critical distinction is where the policy is held. A lot of Australians hold income protection insurance inside their super fund. In that case, the premiums are generally paid from your super balance rather than your personal income, which means the deduction doesn't flow through to your personal tax return. If you're not sure which situation applies to you, check your policy documents or call your insurer before you lodge. It takes 5 minutes, and it could be a deduction you've been missing for years. Deduction 5. Managing investments and capital gains. If you hold shares or other investment assets, there are 2 angles to this deduction worth understanding. The first is the cost of managing your investments. Subscriptions to portfolio tracking tools, fees paid to a tax agent or financial advisor for investment-related advice. And similar costs can be deductible when they're directly connected to earning assessable investment income. Even the cost of software you use specifically to track your capital gains can qualify. Keep your receipts and make sure each expense clearly relates to your investment activities. The second angle is timing around capital gains. If you have any investments sitting at a capital loss right now, shares that have fallen below what you paid for them, it may be worth considering whether selling before June 30th makes sense for your situation. A capital loss can be used to offset capital gains you've made elsewhere in the same year, which reduces your net capital gain and the tax you owe on it. There are rules you need to be aware of. You can't sell an asset at a loss and immediately buy the same asset back. The ATO looks unfavorably on arrangements that are structured purely to manufacture a tax benefit with no genuine change in economic position. That's known as a wash sale, and it can be treated as tax avoidance. And if you've held an asset for more than 12 months before selling it, the 50% CGT discount may reduce the taxable portion of any gain significantly, which is worth factoring into your planning. If your investment situation is at all complex, speaking with a registered tax agent before June 30th is well worth the cost. Which brings us to Deduction 7, because that fee is likely deductible too. Deduction 6. Salary sacrificing into superannuation. This one works differently from the other deductions on this list. It's not something you claim after the fact. It's a strategy you need to have in place before the end of the financial year, specifically before the 30th of June. Here's how it works. Instead of your full salary landing in your bank account, being taxed at your marginal income tax rate, and then you deciding what to do with what's left, you ask your employer to redirect a portion of your pre-tax salary straight into your superannuation fund. That redirected amount is taxed inside super at a flat contributions rate of 15%, rather than at your marginal rate, which could be 19%, 32.5%, or higher depending on your income. For the 2025 to 26 financial year, the concessional contributions cap, which covers your employer's compulsory super guarantee contributions, any salary sacrifice you arrange, and any personal contributions you intend to claim as a deduction, sits at $30,000 in total. Before you top it up, check how much of that cap your employer's super guarantee contributions have already used. If you're self-employed, a contractor, or earning income outside of regular employment, you can still access this strategy. You make personal contributions from your after-tax money and then claim a deduction for those contributions when you lodge your return. Two things to get right. The contribution needs to be received by your super fund before the 30th of June, and you need to submit a notice of intent to claim a deduction to your fund before you lodge your tax return. There's one more lever available to some people here: carry forward contributions. If your total super balance was below $500,000 at 30 June last year, you may be able to use unused concessional cap space from the previous 5 years on top of this year's cap. That means a larger deductible contribution in a single year. You can check how much carry forward space you have by logging into ATO online services through MyGov. Deduction 7. The cost of managing your own tax affairs. This is the most straightforward one on the list, and it's the one people forget about every single year. If you paid a registered tax agent or accountant to prepare your tax return, that fee is generally deductible. But in the following financial year, so the fee you paid during 2024 to 25 for your 2023 to 24 return is a deduction you can claim in this year's return. The same applies to tax-related software and subscriptions you use to manage your records or calculate your investment income. If you're using a tool specifically for tracking deductions, recording capital gains, or generating reports for your return, the subscription cost is worth looking at as a potential deduction. It takes about 2 minutes to add to your return. Don't leave it out. Tax deductions are not a loophole. They're not a grey area. They are a deliberate part of how Australia's tax system works. The ATO publishes them. The rules are transparent, and you are legally entitled to claim every single one that applies to your situation. What this video has given you is a starting point. Go back through the list. Check which deductions apply to your circumstances this year. Get your records together. And if anything feels uncertain, spend a little time with a registered tax agent. That fee, as we just covered, is probably deductible anyway. If this video helped make tax time a little clearer, consider subscribing. We publish practical Australian money content regularly, and there's a lot more where this came from.